Welcome to Business Playbook TV. On this series, the best and brightest business leaders and professionals share their unique insights and update us on current trends in business. As our expert commentators and on-air correspondents, they report for our departments: Business Finance Playbook, Networking Gurus, The Coach's Corner, Marketing Madness, Tech Talk, Sidestepping the Legal Minefield, and CPA Secrets. Today, it is my pleasure to introduce you to Sallie Mullins Thompson. Sallie is a CPA with a business accounting and extensive tax background. Sallie, when a U.S. citizen or resident has assets in other countries, what are their responsibilities in reporting them?
Well, generally speaking, there are actually two reports that are required to be filed. The first one is called FBAR, which stands for Financial Bank Act Report. And this report is filed if a person has a financial interest and or signature authority over a financial bank account in the U.S., outside of the U.S., and the total value exceeds $10,000 during the year. So this is a separate filing from the person's income tax return, and it does not go to the IRS. It actually goes to the Financial Crimes Enforcement Network. So it's completely separate from your tax return. If you have foreign financial accounts, such as your retirement account or a bank account that's on a military banking facility, those do not have to be reported as foreign financial bank accounts. Now, the second report is a Form 8938, which is actually part of the individual's income tax return. And this is for financial interest only, not signature authority, but financial interest only that a person has overseas. And this goes with your tax return if the value of those accounts are over $50,000 if you're single, or $100,000 if you're married, filing jointly, and live in the United States. So you have to file this form even if there's no income from those accounts. Also, the filing of this form does not relieve you of filing the FBAR. And foreign financial assets for this form include bank accounts, securities, mutual funds, any type of investments, businesses, foreign businesses that you might have. Retirement and pension plans have to be included in this form, and any foreign trust states and capital assets that generate capital gains and losses that have to be reported. So, but however, if you have a bank account like from HSBC, which is a foreign bank but has a domestic branch, those do not have to be reported as foreign financial accounts. So these two reporting requirements apply not just to individuals have to report, but also corporations, partnerships, LLCs have to report foreign assets. Any type of business entity that has passive income and that is closely held has to include this form with their tax return.
So what happens if they willfully neglect to report them?
Failure to report foreign assets is a crime. Therefore, if the IRS discovers this, you have to file back tax returns for all the years you had the report. You have to pay any taxes due on the income from those assets for all the years that you've held them. Also, criminal charges may be incurred. You could have fines, you could have to pay restitution, and you could even go to jail. The penalties are really severe in these cases. For the no Form 8938, the penalties are from $10,000 up to $60,000. For no filing of FBARs, The penalties range from $10,000 up to the greater of $100,000 or 50% of the highest value of all of those foreign assets. So that can be a huge penalty. Now, starting in March of 2009 through 2018, the IRS put in place several offshore voluntary disclosure programs. So taxpayers have had 10 years to come forward and voluntarily report basically this crime of not reporting foreign assets. Taxpayers who took advantage of this program received protection from the criminal prosecution. They only had to file several years of back taxes and back tax returns, pay unpaid taxes, and FBARs. So they got relief on how many years they had to go back. And they also paid a lesser penalty, which ranged from either 50% down to 27.5% for the last 4 years of this 10-year period on the aggregate value of the foreign assets. But they only had to go back in value in time for 6 years. So it was a lesser penalty on a lesser amount of assets. And then in November of 2019, the IRS put in place an updated voluntary disclosures procedures. In this case, the taxpayers have to provide slightly more information than for the OVDPs. And they also had to make a pre-clearance request to the IRS Criminal Investigation Division. So that's a little bit more onerous than the last 10 years of OVDPs. And finally, they had to include more tax years for examination. Further, there's no fixed penalty for this. The IRS could actually take all the money. They could charge you 100% penalty. And then finally, a civil fraud penalty is also incurred. It's still better than the if the IRS discovered it without you coming forward.
What happens if they innocently neglect to report them?
Okay, so in this case, there are two programs available. The first program is the Streamlined Filing Compliance Procedure. And in this case, the taxpayer submits certification that this was a non-willful, that's the operative word, non-willful neglect to report these assets. They include an explanation narrative, and they will have to file amended or back tax returns and FBARs for a short period of time, typically 3 years for the tax returns and unpaid taxes, and 6 years for the FBAR. And then the second program here is the delinquent FBAR submission procedures. And this is when a situation where you've already paid taxes on that income, or there was no income on the foreign assets, and you just file these late FBARs with an explanation of why they were not filed timely. So those are the two programs for the non-willful situation.
So Sallie, you must have interesting stories about this issue. Can you share one or two with us?
The first one is a non-willful case, and the first one is a willful case, and the second one is a non-willful. So the first one is a sort of sad. It's a lady who's 88 years old, and she was part of a 2017 offshore voluntary disclosure program. It was willful because she moved money from a Swiss bank that was required to start reporting their account holders to the U.S. government. She moved it to another overseas bank that was not required at that time. So that made her case willful. And she got the money from her father, who was in her 20s, and this goes back to the 1950s. her family came to the United States after she was born as a result of World War II. And her father told her that this was secret money and that she was never to tell anybody about it. And that is why she took the actions that she did. However, it was a willful case. And the result of the case is that she ended up paying, when she found out that she could actually go to jail in her 80s, she ended up paying a penalty of 26.5% penalty on the aggregate value for the last 6 years. We filed 3 years of amended returns, 6 years of FBARs. It cost her about $75,000. The other story is very interesting. It's an example of a non-willful situation. This is a young man, 40 years old. He was actually born in the United States of Spanish parents. The family moved back to Spain when he was 10 years old. He had a U.S. passport for the move. But he obviously got a Spanish one later when he became an adult. He never returned to live in the United States. He married a Spanish national. However, due to work, he's the Chief Technology Officer of a growing software development company. He began traveling to the United States in 2012 to attend tech conferences in Los Angeles. He was stopped at customs. He was traveling on a Spanish passport. He was stopped at U.S. Customs and asked, you're an American citizen. Why are you traveling on a Spanish passport? So it turned out that he had never relinquished his U.S. citizenship. He was advised by Customs to renew his U.S. passport and use it to travel, because he regularly travels to the U.S. on to these conferences. So then fast forward to 2019, his company is involved in a merger, and it came to light that he's a U.S. citizen, and the Spanish council wondered if he had U.S. tax reporting requirements. And they reached out to his contact here in the United States, and it was determined that this young man does, in fact, have U.S. tax reporting requirements. Not only does he have his own, and so as a U.S. citizen, he now has to report foreign assets, which are basically his personal accounts, as well as the 10 business accounts of the company, because he's got signature authority over them. So therefore, in this situation, we're using the streamlined procedures. There will be an application with the narrative explaining the non-willfulness of this situation, and then we will file 3 tax returns, back tax returns, and 6 back FBAR filings.
Sallie, how can people reach you?
Well, there are 2 ways. The first way is through my email, which is SallieMT, that's SALLIEMT for Mullins Thompson, at smtcpallc.com. You can also go to my website, which is www.smtcpallc.com.
I would like to thank our guests for appearing on Business Playbook TV. Please tune in for our next episode. Until then, this is Bruce Stout saying thank you for joining us and have a great day.